Welcome, 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 everyone. As we're having some people file in and join us, first we want to tell you thank you for taking some time out of your day to spend it with the four of us. We always hope you enjoy our town halls, and we genuinely again thank you for taking some time out to spend it with us on this beautiful Wednesday. We do apologize that we are doing this on a Wednesday as opposed to our normally scheduled program, which are on Tuesdays, usually after the start of a new quarter. But we are teaching classes this week, so we had to back it up one day. That being said, again, we do thank you for taking some time. If you can believe it, it's 2024. We are what? We are 1 week into the to February of 2024, which it still blows my mind. I'm still writing 2022 on paperwork. So, and this is our first town hall of the year. As a quick reminder, our virtual town halls are a quick recap of what has happened over the last quarter within the market, mixed with our thoughts, along with updates within the financial planning realm, like tax changes, estate law changes, etc. Updates on our firm, updates with LPL, and everything in between. We do try to make this town hall, which we call the Elliot and Mike Show, short and concise, at most 20 to 25 minutes. We are broadcasting on Zoom, and we will go through a couple of graphs. But if anyone wants to call in, we try to talk through the graphs, talk through all the information so that if you ever want to call in versus joining via Zoom, all of the information of the presentation should be easily digestible and understandable. So either way works well. Before we jump on into the material, we do have to go through a quick disclosure. Ben, can you put the disclosure on the screen for everyone? Investment advice is offered through Prairie Sky Financial Group, a registered investment advisor and separate entity from LPL Financial. This material is intended to provide general financial education and is not written or intended as tax or legal and investment advice, and may not be relied on for purposes of avoiding any federal tax penalties. Individuals are encouraged to seek advice from their own tax or legal counsel. Individuals involved in the estate planning process should work with an estate planning team, including their own personal legal or tax counsel. This material is for informational purposes only and is not an offer to sell or a solicitation of any offer to buy any securities. With that, as we start the year and as everyone starts to file their tax returns, we kindly request that everyone that you please send us copies of your 2023 tax returns after they are filed for our clients and our clientele. Now, Jen, for our clientele, what are some options for clients to get us copies of their tax returns, and why may this be important?
We do have a couple of options. You can upload to us through our secure site. You can mail a copy into us. We can, if that's the easiest for you, we can send you a FedEx envelope and you can mail those back into us. Or you can stop in the office if you're close enough and we can make a copy while you're here.
Beautiful, beautiful. As we cover within our reviews, tax planning is a pillar of a thorough financial plan. But that's not the only thing that we need and what we'll need regularly. Ben, what are the things that we're going to be asking for and looking throughout the year from our clients, our clientele, and how will we go about requesting those items from our clients?
Yeah, so we'll be reviewing several documents, including your 401k statements and other outside statements, as well as Social Security and PBGC statements. And as Elliot said, your tax returns. And this enables us to offer you guys personalized and well informed financial advice tailored to address your specific needs. And either Jen or I will be reaching out to you guys to collect those statements and documents from you.
Beautiful, beautiful. I think that along with those lines, it's always nice to have as much information prior to our reviews as possible. That way, when we get together, we're making and spending that time together as productive or make it as productive as possible. So if you have any questions on our processes, if you have any questions for Ben, Jen, myself, or Mike, please feel free to give us a call. We're always happy to help. Now on to the good stuff. As a quick reminder, as Ben is pulling these up, these slides are available if you just Google JP Morgan Guide to the Market. It's free. You don't need to make an account. It's available 24/7. And JP Morgan Asset Management updates this quarterly. None of these items that we're discussing today are guarantees or are expectations that we are setting. I'll remind everyone of this at the end of the call, but we have no idea what the market's going to be doing in the next week, month, year, 2 years, 5 years, etc. That being said, context on what the market may be doing with any kind of time frame can be helpful and can be potentially it could potentially relay news to continue to be optimistic and or to be prepared for whatever volatility may come around. So we're going to start off on page 15 of the guide. This forecasts GDP. Now, Mike, what exactly is GDP?
Well, what Elliot's referring to is a measurement of the strength of the American economy. GDP is gross domestic product. What it does is measure spending and vicariously America's feeling about the economy. It measures consumer spending, people going out and buying refrigerators, cars, buying houses. It measures how much businesses are spending, and that's a show of strength because businesses want to expand, and if they're spending money, they're likely expanding. And it also represents government spending. And as we all know, when the government spends, there's a whole lot of the United States that benefits from that flood of money into the market. So what's on an average basis is 2 or 3%. Last quarter, it was up by 4.9%. So when you're hearing on the radio, on TV, CNBC, that the economy's strong, it's not the economy speaking, it's all of us out in the marketplace, all the businesses and the government that are saying, hey, we have confidence in the United States.
Beautiful. Yes, as Mike mentioned, we don't have the full fiscal year 2023 GDP numbers yet. It's still being tabulated. However, in the third quarter of 2023, we had a 4.9% GDP growth, which is obviously well above a 2.2% trend growth. We hope that this is an optimistic number and a number that makes you feel optimistic of maybe some room that the market has to grow. Now on page 24, as Ben is scrolling through, this illustrates wage growth. In November 2023, we saw wage growth at 4.3% and unemployment at 3.7%. Both of these numbers are better than their 50-year average. We continue to see it as evidence that this is a labor market that is getting back to normal, as we have seen some outliers over the last couple of months, over the last 2 years, but we continue to see positive aspects to it. This compounded with, on page 25, when I say getting back to normal, thank you, Ben. In March of 2022, I'm looking at the graph on the left, job openings. In March of 2022, we saw 12 million job openings. This was obviously an astronomically high number. So when I say normalizing, we're seeing the job openings coming back down. As of October 2023, we had 8.7 million job openings. That number has continued to drop a little bit. Now, these are still very high numbers compared to the historical trends dating back to 1973, but we still see it again as a normalizing trend, as it's coming back down to so to speak, coming down to the normal trends that we usually see. So what's another hot button item that we've discussed over the last 2 years? Inflation. Now, getting to page 27, we saw inflation drop in November 2023 to 3.1%. This is well below our long-term average of 3.9%, but still a little bit higher than the Federal Reserve's target of 2%. They typically want to see CPI, or which is just a calculation for inflation, to somewhere be around 2% year over year. Now, just as a reminder, we try to build into our retirement projections and the retirement plans a 3% inflation rate, as that has been the trend over the last 20 years. But that doesn't include education, student loans, so to speak, or tuition, and long-term care / assisted living. As a quick reminder, we were able to bring down our inflation that we saw back in 2022 as well by increasing interest rates. So what does that mean? Moving on, if we go to page 31, I will explain. What do I mean by increasing interest rates to drop inflation? Starting in 2022, the Federal Reserve started to increase interest rates, or what is known as the Fed funds rate. The Fed's fund rate is the interest rate at which banks lend to each other. As the interest rates continue to climb, it becomes more expensive for banks to lend it out to consumers like individuals and businesses. This makes it more expensive to get car loans, mortgages, credit cards, etc. And that slowed down our hot economy in 2022. And obviously, we saw a negative return in 2022. Now, as you can see on page 31, we saw in 2022 interest rates, or the prime rate, jump up from 0 up to 5.38%. But something interesting is happening. The Federal Reserve and Jerome Powell has said, he just said it last week, hey, we're going to be dropping interest rates most likely 3 times this year. This presents an opportunity. And if you look as well on page 31, or is it page 33 of the 31 of the guide, the long-term projection that the Fed's trying to get to is 2.5%. So they want to cut rates by about 50%. So if that takes place, what does that mean for maybe the bond market? What does that mean for maybe some investments? Ben, if you could turn down to page 33. If you look on the right side of the graph of the guide on page 33, we're looking at the blue part of the graph. If we see a 1% cut, historically speaking, U.S. aggregate, Ben, if you could circle that on the screen as well, U.S. aggregate bond index, a little too far. When we see a 1% cut in interest rates, there are some fixed income categories that may be advantageous to hold in lieu of owning just straight cash or money market accounts. That's been a big item that we've discussed over the last 18 months. So, for example, if you own the U.S. aggregate bond indexes and the interest rates in general drop 1%, historically speaking, we see around a 10.2 or 10.8% increase in the broad U.S. bond index. Now, this isn't a guarantee or forecast, but this is something that Mike, Jen, Ben, and I are looking at within our client portfolios and saying, does this maybe make sense to relocate some money market or cash into these positions so that we can have an appropriate risk-adjusted return? So that's fixed income. But what about equities? We're now going to turn to page 14, and this is one of Mike's favorite graphs. So Mike's going to jump on in. Mike, what do you glean from this?
That it's too small. Can you get it? Can you magnify it a little bit, Ben? Okay. What this is a timetable of when to buy stocks. This goes back 44 years. And we look at the performance of the S&P 500. That's the Standard & Poor's 500 biggest, most well-managed companies in the United States. And I want to focus on, instead of all the increases, I want to focus on the losses that we've had since 1980. That was when inflation that we had last year was nothing. That was nothing. If people remember in the 1980s, inflation was 15%. You could get a CD for 15%. But food costs went up 20%. So you were getting behind 15% in savings, and you were losing money by putting money into savings. Take a look here. 1981, first day, the market lost 10%. Look what happened the next year. Market was up 15, 17. Let's look, Elliot, at 1990. Market was down 7%. What happened the next year? Market was up 28. Look at 1994. Market was down 2%. Market was up 34% in the subsequent years. The one time in our 43-year period is in the tech bubble of the 2000s when the market was down 3 consecutive years. It's only happened once, because every other year that we've had losses in the market, including 2008, when the market was down 38%, market was up 23% the next year, 13, zip, 13, 30, 11, down 1 So here's what we can glean. Oh, let's look at the most recent one. In 2022, the market was down 19%. What happened the next year? It was up 24% last year. What I hope that I'm conveying to you is that a year in the market when it's negative may be the best time at all to put money in the market, because 90% of the time we've had in the last 43 years, a down year in the market, it's recovered. Now, think of that. 93% of the time when the market goes down, I'm going to put money in the market because I've got a 93% chance of having a gain the very next year. If there was a casino, well, there's one in Chicago down the street from me, but if there was a casino and there was a chair there, and you could win by putting money on the table 93% of the time, you'd never leave that seat. Well, the stock market works the same way, in that losses in the market are temporary. Changing your strategy when the market's down can be fatal. So that's why we encourage to stay invested, because people that stay invested in the marketplace are virtually always rewarded. Thank you, Elliot.
Beautiful. With that in mind, I want to turn to page 60 of the guide. We've talked about bonds. We've talked about fixed income. We've talked about equities. Ben, can you zoom in a bit? Perfect. The line that we're looking at, the graph that we're looking at right now, is a typical 60-40 portfolio. Okay. It's what is considered an asset allocation model, because most of us don't own just pure equities. Most of us don't own pure bonds. Most of us don't own pure cash. It's usually a mix of that. So how is a typical 60-40 portfolio done since 2008? Well, it was down 25, up 25, up 13, et cetera, and so on and so forth. Last year, that portfolio was up about 14%, preceded in 2022 by 13.9%. The reason I want to illustrate this is because there is no one perfect investment. There is no one perfect asset class. There is no one perfect strategy. The best thing we can do is stick to the plan that we carefully curate. To expand on Mike's point as well, I'm going to turn to page 63 of the guide. And by me, I mean Benny. What I'm looking at is the volatility of returns on a 1-year, 5-year, 10-year, or 20-year basis. If we're looking at what are the historical S&P 500 returns on any 20-year rolling period, what is the average return? The average return is 11.2%. But let's take it a step further. If we're looking at the graph on all the way on the right, which illustrates the high and the low return, the highest return we've averaged in any 20-year period was 17%. The lowest average return we've had on any 20-year rolling period has been a positive 6%. What I am summarizing is that if you stay the course, often, if not always, I don't want to make it sound like historical performance is a guarantee of future success, but historically speaking, staying the course, staying invested has come with good returns. With that in mind, you're going to often hear Mike and I always say the same thing. You have to stay invested. The best thing you can do is stay invested. As always, we do want to thank you. We're going to wrap up now. It has been 20 minutes, so we do want to try and make this short and concise. This is going to be recorded for any of our clients that are on the call today. This is going to be available on our website after we put it through compliance, so it will take probably somewhere around 5 to 10 business days to get it approved, and then on our website underneath webinars on our website as well. So if anyone has any questions on anything we've discussed today, please feel free to give us a call, shoot us an email. We're always here to help you. We thank you for the vote of confidence, and we look forward to seeing you in the reviews or at the next town hall. Have a great rest of the week, and thank you for your time.